Welcome to our class today. And we are going to discuss about consolidation. To begin with, just want to make sure that we are sharing the right content. Introduction to group accounts. My name is Paul Mpalawe, and I'm a certified chartered accountant, a member of the Association of Chartered Certified Accountants, ACCA, and I also have a Bachelor of Accountancy degree with a credit obtained from the University of Malawi. I'm currently working as an accountant for one of the construction companies in South Africa. And I'll be delighted to take you through the introduction part of the group accounts on the first part of this video. And later we're going to do complex group accounts, complex consolidation. The key learning objectives. Number one, we're going to describe the concept of the group and single economic unit. And later we're going to discuss about the definition of a subsidiary within relevant accounting standards. And number three, we're going to learn about using accounting standards and other regulation, identify and outline the circumstances in which the group is required to prepare consolidated financial statements. And on the fourth objective is to describe the circumstances when a group may explain exemption from the preparation of the consolidated financial statements. Sometimes a group may claim the exemption, and we are going to understand what those exemptions entail. And then we're going to explain why directors may not wish to consolidate a subsidiary, and when this is permitted by the accounting standards and other applicable regulations, depending on which country you are operating your business. And objective number 6 is to explain the need for using conterminous year-ends and uniform accounting policies when preparing consolidated financial statements. And later we're going to be able to explain the objective of consolidated financial statements. Okay, the introduction. Most large businesses consist of several companies that are controlled by one central administrative company. And that administrative company may call a group. We've got several examples of a group of companies. Within the group, there are subsidiaries. So the controlling company is called the parent or holding company. And this holding company will own shares in several companies. Okay. So we've got a continuum here, or a scale from 0 to 20%. If a company owns less than 50%, that is termed as significant influence. And we use, that is basically an investment. And we use IFRS 9 to account for such kind of investments. Why is the company owning, or why does a company have significant influence? It's because it's got the power in one way or another to have a say in the boardroom. Okay. And if a company owns more than 50%, like 51% going forward, that's when we use full consolidation or equity accounting. Okay. There are many reasons for businesses to operate as a group, for goodwill associated with the names of the subsidiary, and sometimes for tax purposes, sometimes for legal purposes. That's why most of the business would prefer that individual companies operate individually, and then when for reporting purposes, the holding company may report as a group. Okay, the main accounting standards that guide a consolidation process Number one, the IFRS 3 business combination. We're going to discuss about that. IFRS 10, consolidated financial statements. And IFRS 13, that's fair value measurement. Previously, there was IAS 27 and IAS 28. But now we are talking about a new standard, IFRS 10, consolidated financial statements. So let's look at the key definitions. And when you talk about control, that's when an investor controls an investee. There has to be an investor, a company that is investing, an investee, and the company that is being invested in. When the investor is exposed or has rights to variable returns from its involvement with the investee and has ability to affect those returns through power over the investee. As prescribed by IFRS 10, when we say control is when the one who is controlling or the company that is controlling is exposed or has rights to variable returns. Variable returns shall mean profits or losses that a business may make. Okay. So power shall mean the existing rights that give a current ability to direct the relevant activities of the investee. So the company that owns shares in another company has got the power to direct how things should be run, how the business should be run. Okay. A subsidiary is an entity that is controlled by another entity. So if a company invests more than 50%, the company in which it invests becomes a subsidiary of the parent company, the holding company. Okay. The parent company is an entity that controls one or more subsidiaries. So a company P can invest in company S1 55%, and can also invest in the shares of S2, subsidiary 2, 80%. It can also choose to invest in S3, subsidiary number 3, maybe 100%, as it may please the directors of the company. So an associate is an entity over which an investor has significant influence and which is neither a subsidiary nor an interest in a joint venture. So if a company invests from 1% to less than 50%, say 49%, okay, that's basically significant influence, as we alluded earlier. Okay. So significant influence is the power to participate in the financial and operating policy, decision-making of an investee, but it is not control or joint control for those policies. Okay. All right. So investments in subsidiary. As prescribed by IFRS 10, the standard provides a definition of control and identifies 3 separate elements of control. Number one, the power over the investee. When you're talking about power, when one company has power over the other, it tells the other company what to do. Okay, so we're going to look at what this power entails, what this power means. Okay. Number 2, exposure to or right to variable returns from its involvement with the investee. Number 3, the ability to use its power over the investee to affect the amount of investors' returns, sorry. Okay, when we talk about power, this power can be directly obtained from the ownership of the majority of the voting rights, or can be derived from the other rights. For example, the right to appoint, 1, reassign the key management personnel who can direct the relevant activities in the business. If the controlling entity has got power to appoint a chief executive officer, for example. The power to appoint or recruit the chief finance officer. In some companies, they call him the finance manager. Or can have the power to appoint the finance director in a company. That's one of the signs that the company has got the power. Okay. Another power is rights to appoint or remove another entity that directs the relevant activities. Okay. Number 3, another demonstration of power is the right to direct the investee to enter into or veto changes to transactions for the benefit of the investor. So this holding company has power to tell the subsidiary or the company that it owns the shares where to invest the money, how to invest the money. Okay, so it's got the power to get exposed to different levels of risks, in other words. Okay, the other rights, such as the right to create a contract. Okay, this holding company has got more power, or the owner of the holding company has got more power to direct how activities of the business should be run, the direction of the company, where the company is going. Okay. So to continue, the existing significant influence is evidenced in one of the following ways. Number 1, representation on the board of directors or equivalent of the investee. The composition of the board of directors of the investee. How many directors are from or are appointed by the holding company? Okay. The significant influence can also be manifested in the participation of policy making process. So there's no process that can be made without the influence of the company that is owning a significant amount of shares in the business. Another significant influence can be protruded through material transactions between the investor and the investee. 3, 4, interchange of management personnel. How is the management personnel be interchanged? So this company that's got significant influence has a say on it, and a provision of essential technical information on how the company should be run. So in summary, we are saying that when a company invests more than 50%, it has control over the affairs of a subsidiary. So the investment is a subsidiary because the company, the holding company, has invested more than 50%. And what do? We use full consolidation process as prescribed by IFRS 10. When a company holds 20% and less than 50%, that company becomes an associate. So we use equity accounting as prescribed by IAS 28. So any other investment other than that is prescribed, or we use IFRS 9 to account for such kind of investment. So what are the exemptions for preparing consolidated accounts? Number 1, when the parent is itself a wholly owned subsidiary, or it is a partially owned subsidiary of another entity, and its other owners, including those not otherwise entitled to vote, have been informed about that. and do not object to that proposal. So the parent cannot present the consolidated accounts, or is not mandated to consolidate, in short. Now, second exemption is when the securities of the business are not publicly traded. So it's not mandated in any way by law to present. Because remember, consolidation is just a presentation of financial statements. But within the consolidated accounts, the company is supposed to report the financial affairs of individual accounts or individual companies, or accounts for individual companies. Okay, so that the decision makers would be able to see the composition of the statement of affairs within the accounting period. Okay. Another exemption is when the company is not in the process of issuing securities in the public security market. Okay, when the company is not ready to sell its shares on a stock exchange. Okay, Johannesburg Stock Exchange or Malawi Stock Exchange, depending on where the company is operating its business. Another exemption is the ultimate or immediate parent publishes consolidated financial statements that comply with international financial standards. So remember those 4 exemptions. All right. So what would be the content of the group accounts and the group structure? So consolidated accounts are one form of group accounts which combines the information contained in separate accounts of holding company and this is a subsidiary as if they were the accounts of a single entity. So that's the whole purpose of consolidating. This group, this holding company is reporting back as if it's trading as a single entity. Okay. So a set of consolidated accounts is prepared in adding the assets and the liability of the company. So there are rules that need to be followed when adding these numbers. That's the whole reason we are learning about consolidated financial statements. We don't just add left and right. There is a rule that needs to be followed as prescribed by the standards. So the whole of the assets and liabilities of each company are included, even though some subsidiaries may be only partly owned. Okay. The equity and liabilities section of the statement of financial position will include how much of the net assets are attributable to the group and how much to the outside investors in its partly owned subsidiary. These outside investors are known as non-controlling interest. So the areas to calculate: number 1, you should be able to understand the group structure. How much does the parent company control in a subsidiary? Is it 55%? Is it 80%? Is it 100%? Is it 90%? So you need to understand that area. So in understanding the group structure, you should also be able to know how did the parent company acquire, or how did the parent company pay the shareholding in the subsidiary? Is it a share exchange, or did the parent company pay on cash? Okay. So these things have to be understood before you calculate a goodwill. Secondly, you need to calculate goodwill. So you need to understand what the examiner is looking for. Is the method partial or the method full goodwill? So there's a bit of a difference on how to come up with goodwill. We're using these two methods. Another thing that you need to calculate is retained earnings. Retained earnings. Number 3, non-controlling interest, NCI. Sometimes there may be intercompany trading, and in the process, the goods are still in stock, and there's some sort of unrealized profit. You also need to calculate that and present how much is a unrealized profit. Sometimes there may be outstanding amounts. The parent may be trading with a subsidiary, and at the end of the day, the parent may have receivables, and the subsidiary may have payables for the parent, and these have to cancel each other. That's the only time when accounting allows us to cancel, to offset. In other words, cancellation shall mean offsetting the receivables from one and payables from the other. Okay, so we've got an example here that we need to share. Okay, let's look at the example consolidation. On 1 January 20X1, Singapore company paid $90,000 for a controlling interest of 80% in Marina Bay company's equity, when the retained earnings of the Marina Bay company were $25,000. The summarized statement of financial position as at 31st December 20X2 as follows. So we've got Singapore and Marina Bay. So the examiner is asking us to consolidate. So let's look at the additional information. Number 1, at the date of acquisition, the fair value of NCI of Marina company was $20,000. So what is the purpose of knowing the fair value of NCI? It's because number 1, we should know and be able to calculate the post-acquisition profits and share them as per the shareholding. Okay. Number 2, for consideration purposes, at the date of acquisition, the fair value of non-depreciable land of Marina Bay company exceeds its carrying value by $25,000. Marina Bay company has not incorporated this fair value adjustment into the individual financial statements. At the reporting date, Singapore company is owed $5,000 by Marina Company Bay. That's what I was talking about, the intercompany outstanding accounts. So required, prepare the consolidated statement of financial position for the group of Singapore Group as at 31st December 20X2. These balances are as at 31st December 20X2. Okay. Remember, the company purchased when? On 1st January 20X1. So number 1, the first presentation is group structure. Okay, we've got a parent company here named Singapore. Okay, I'm just gonna copy the name and present it down there. So let's see group structure. We've got Singapore and subsidiary is Marina Bay. Let me just copy this and paste it down there. So as we said, first thing to do is to understand the group structure. Marina Bay is a subsidiary. So let me just insert so Singapore owns shares in Marina Bay. When was, okay, so the shares is 80% parent, that's the owning capacity. It means out of 100, 20% is what? Is NCI. So the most important thing also to note is when was the parent, when did the parent acquire shares? 1 January 20x1. Okay. What is another thing that we need to understand here? So before we prepare the consolidated financial statements, we need to calculate the main workings. Okay. Working number 2 is what is called net assets of a subsidiary. Number 2, net assets of subsidiary. At acquisition and at reporting, then we have growth or the difference. Or sometimes it may be called post acquisition. When you read other books, they call it growth. So we're going to see these 3 here. Okay. So let's look at equity. You know, equity doesn't change. And how much is equity? If you look here, equity of the subsidiary is 15,000. So I'm going to copy that amount and paste it. So equity at acquisition was $15,000, meaning to say equity at reporting doesn't change, it's still the same. Okay, so this minus that, it's 0. Okay. Retained earnings. Return earnings. We are told in the question that retained earnings at acquisition, at the date of acquisition, let's see on top. On First January next one, Singapore company paid $90,000 control interest, 80% in Marina Bay company, when the retained earnings of the subsidiary, Marina Bay, were $25,000. So when the company was acquired, the retained earnings were $25,000. But at the reporting date, the retained earnings were how much? We will take it from the balance sheet. The statement of financial position were 40,000. Okay, it means there's a sort of movement, and that movement is post-acquisition profit. So we take 40,000 minus 25,000 to find the post-acquisition profits. Okay, so that's all. Is there any change? Yes, there is. If you see on note number 2, the consolidated purposes, for consolidated purposes, at the date of acquisition, the fair value of non-depreciable land, you know, land doesn't depreciate, doesn't lose value. So there was an element of land increase that was not incorporated in the financial statements, which is $25,000. It means we need to incorporate it. So land at acquisition, $25,000. At reporting, it's the same amount, $25,000. So movement there is no movement. Okay, so this one is fair value land adjustment, which is called fair value FOV land adjustment. Okay, so it means that on acquisition, the total net assets were how much? It's an addition, sum total 65,000. At the reporting, the sum total is 80,000. Movement from 80 to 60, from 65 to 80 is a 15,000. Where the 15,000 is coming from? Retained earnings element. So it's the same as taking the sum total of the growth or post-acquisition. Okay. So we are good to calculate goodwill. Okay. When you find a good marker, all these steps, a good marker will give you something. So number 3, we should calculate goodwill. What is goodwill? Goodwill is excess of net assets that was paid by the holding company, the excess. Okay, and this goodwill comes in because when you're buying a company, you're also buying the name of the company or number of customers. So it's a combination of several things. It can be number of customers, it can be the brand itself, the good vibe of the business. It's already an established company. So when companies are selling their company, they factor in that. Someone who evaluates the value of the company, factor in that. So let's see this company. How much was goodwill paid? So on 1 January, Singapore paid 90,000. So consideration transfer, sorry. We say consideration transfer. So, or fair value of parents' investment as given in the financial statements. Here, investment in Marina Bay, 90,000. Okay. So that amount is 90,000. Then we need to factor in, we need to add NCI at acquisition. At acquisition. Fair value of NCI at acquisition. We are given this amount here. So at the date of acquisition, the fair value of NCI of Marina Bay was $20,000. We need to add $20,000. Then we need to reduce less fair value of net assets of subsidiary. How much was the value of the subsidiary at the date of acquisition? So it's this amount here. Okay, or let me remove this one. So we need to reduce by 65,000. So the goodwill, the value of goodwill will simply be consideration transfer plus the NCI, fair value of NCI acquisition, minus or less the fair value of net assets of subsidiary at the date of acquisition. Remember, we are taking fair value of NCI at the date of acquisition, not at the date of reporting. Why are we taking, someone would ask, why are we taking the fair value of NCI at acquisition? Because that's the date when the parent company paid or acquired the shares in the subsidiary. That's when that's when Singapore acquired shares in Marina Bay. Okay. Another calculation that we need to make. So sometimes it may happen that this is a goodwill at acquisition. It may happen that within the year, there was some sort of impairment or the loss in value for some reason. And that impairment is taken out of the goodwill before we report, before we put the number of, before we put the amount of the goodwill in the consolidated financial statement. Remember that. So another calculation that we need to make is that of NCI, non-controlling interest. We have already described the non-controlling interest in the slides. You can go back and find the definition. So we have the opening balance at the date of acquisition, the NCI, the amount is given here, 20,000. Okay. Is this amount 20,000? Or it's here in the notes. NCI was 20,000. So I'm not dreaming about that. Okay. Then we need to add share of post-acquisition profits. The share of post-acquisition profits. Where are we getting the number? It's here, 15,000. There's a share of NCI there. So we're gonna say 15,000 times 20%. Why are we taking 20%? Because that's a value, that's a percentage holding of the non-controlling interest, or the non-controlling element of a subsidiary, or the non-controlling percentage of a subsidiary. So at the reporting date, the NCI is 20,000 plus 3,000. That is 23,000. Okay. It may happen that, it may also happen that the non-controlling interest can also be affected by the changes. If it was a loss, the non-controlling interest could have taken the post-acquisition element of a loss. It's not only when it's the company made profits. Okay. So this is working number 4. Working number 5 is the element of retained earnings. We call this group retained earnings. That's working number 5. Group retained earnings. So as given in the balance sheet, as statement of financial position, parent, how much is retained earnings for parent? Let's see, equals retained earnings for parent were how much? 100,000. That's what you're gonna take. Okay. Then we're gonna add a percentage of post-acquisition profits. Remember, it's a percentage. So it's 80% the holding capacity times 15,000 here. Parent share is 12,000. So at the reporting date, what you're going to report as retained earnings is 112. This is a balance at reporting date. Okay. Then we can now consolidate. Consolidation shall mean adding all those numbers and coming up with a group account. So first of all, for non-current assets, here I should put dollar because we are reporting dollars. We have goodwill as we calculated here. How much is goodwill? 45,000. Okay, just correct here. Goodwill. Then we have PPE, property, plant and equipment. On property, plant and equipment, what are we going to do? We're going to add PPE for parent plus PPE for subsidiary, okay? Plus, remember, there's a land fair value adjustment of 25,000. This one here, plus 25,000. It means PPE is 85,000. Okay. Then we're gonna also add current assets. Current assets. How much is current assets? We're gonna take current assets of parent, which is 30,000, plus that of subsidiary. Okay. Minus, there's a note somewhere down there. They said what? At reporting date, Singapore company is owed 5,000 by Marina. It means the 5,000 is in return, is in current assets. So we need to reduce it here. Okay. So if you are to add total assets, current assets plus non-current, it's 185. Okay. Let's go to equity. And liabilities. Okay. Share capital. We're taking the share capital of parent only. How much is share capital of parent? We go back in the balance sheets. We take the share capital of parent company only, which is 25,000. Okay. Remember, it's a rule. It's a rule that take the equity of parent only. Then NCI, sorry, retained earnings. Retained earnings. Retained earnings. As we calculated here, 112. It's already here. Then NCI. NCI. Remember, I need to put a working. NCI is working number 4. NCI, it's working number 4. Retained earnings is working number 5. Working number 5. Okay. I'm going to be fast just to catch up with time and make you understand later. Okay. NCI, we calculated NCI to be 23,000. Okay. So total equity, it's how much? If you add these two, it's 160. Total equity, it's 160. Okay. Then we've got an element of liabilities. Liabilities, we're going to combine that of subsidiary and parent. And here it is 25 plus 5 minus the intergroup of 5,000. Remember what we did on assets, we should do the same on liability side. So it's 25. Meaning to say the total 160 plus then our balance sheet balances. Okay, total assets at 185, equity plus liabilities combined 185. Okay, that is consolidated financial statement. I hope that this explanation will help you to understand basic consolidation when it comes to preparation of consolidated statement of financial position. Thank you very much.